Okay, so thanks for having me. So today we are going to be getting in through to a fair amount of detail on pre-earnings trades primarily, even though we can cover different phases of earnings trades that you can do. But in my opinion, the best edge tends to be pre-earnings. But we can also trade the earnings event itself, and also there are post-earnings trades that you can do. So what I've been doing over the past month here is to fully document all of the trades that I've been doing, um, so that I can then present that through to you guys, and you can actually see real trades rather than just, things that's just a back test or something like that. You go, is this real or not? This is all, traded with real money and real fills, real commissions, and all that kind of thing. And I thought it would be good to show that as we go along. All right, so let's get in. Now, the first thing that we are going to have a look at is understanding the concepts and the theory behind what creates edge, and in particular, trying to knock off some things which some people think is true that actually is not. And there's a couple of misconceptions that we need to, get rid of and then move on. So this is a chart over here where the y-axis is the implied volatility. And then down here, we basically have 0 being the earnings day or the earnings event itself. Then if we go to the left, this is days before earnings. So this over here would be 5 days before earnings, 10 days before earnings, and so on. And then to the right, we have post earnings, right? So 5 days after the earnings event, 10 days after the earnings event, and so on. So this is time, but with earnings being right here in the middle. And what we can see with regards through to IV is that, roughly 2 to 3 weeks before the earnings event, on average, and this is across something like 2,000 stocks or so that this white paper was focused on, you could see that on average the implied volatility increases pre-earnings into the actual earnings event. Then during the earnings event itself, you could see that there's a huge vol crush, and then after the earnings event, um, you could say that this is kind of like trending down if I tried to draw a regression line through there. But let's just say more or less this is kind of like a sideways chop after the earnings event. So three very distinct phases of what happens, at least with regards to implied volatility. And these three phases here are also the three focal points that you can choose to focus on with regards to what type of trade you want to do. So either pre-earnings, earnings itself, or post-earnings over here. And there are different types of trades that can take advantage of what you see over here with the implied volatility, but in particular also with regards to the price, which is in the end all that matters. Okay, all that matters really is the prices of the options. You want to buy low, sell high, as you guys know. Whereas when we're looking at a chart like this is a derived value, something called implied volatility, which can throw people off. And let's just kind of start on that aspect of it, right? So what will normally happen is that if you're looking at a chart like this that says implied volatility is going to go up, then what are you going to do? Well, the obvious thing to do to try to make money from this phase here is to put on something that is long vega. Okay, that has positive vega in the trade. Because if we know that IV is going to increase and we have positive vega, that means that for every point of volatility increase, we're going to make some money. That's what we want. So that is what this phase here is. Then this phase here, if you're expecting a huge vol collapse, what do you want to do? Well, obviously you want to be short vega during this area over here. So what's the typical trade that most people will do? Well, that will do a short straddle like that because that has a lot of negative vega, and put that on during this particular event over here. And then if you know that volatility is more or less going to chop around sideways and price action itself may chop around sideways as well for your post earnings event, what you could sometimes consider is doing something that will straddle. Actually, I probably shouldn't use that word because that's an actual option trade, right? But something that brackets that price action, and maybe you could do something like a 9 condor as an example, right? So that is the traditional thinking when people look at this particular graph here. But again, it's a derived number IV, as you'll learn about in a second. So when you then use actual data to look at actual trades and you track, so what each one of these lines over here is this is the prior earnings events. So this is the most recent one, and this is the prior earnings, 2 earnings before that, and so on and so on. And then what they're doing here is they're basically tracking, like what we saw before, the implied volatility on the y-axis. And this red line over here represents the actual earnings date itself. And we see what we kind of saw back here, right? Which is that a couple of weeks or something like that before the earnings event, we see volatility skyrocket. So you might say, awesome. So therefore, what I'm going to do is I'm going to pick maybe, say, this point or this point over here on that particular day, which is 4 or 3 days prior through to earnings. And if I initiate a trade right here and I put on something like a long straddle or a calendar or something like that that is long vega, then by me being long vega, I should make money if IV increases. And this thing shows me that almost without fail, as a matter of fact, not a single line goes down during this particular period. Every single IV line goes up. So you might say, this is a guaranteed way to make money, right? I can't lose. Well, that's not entirely true. So because remember, what this is trying to show you is the implied volatility, which is a derived value. Now, if we then look at real prices are doing almost the exact opposite. So during those days where we said it should be a perfect entry there, so let me go back again. So if we say 3 or 4 days prior through to earnings, if we initiate a trade over here, we should make bucket loads of money, right? Based on this chart. But then when we look at the actual prices of those option contracts, we see that even if we initiate in this period over here, you could see that pretty much every line goes down, not up. So that is in complete contradiction through to the prior chart. And this over here is reality, because remember, we're just buying and selling stuff when we're buying contracts or selling contracts. Whereas this thing over here is the mirage. This is the fiction. This is the derived value that actually doesn't necessarily have meaning. It may have correlation through to other certain things, but this can be very, very misleading when you're looking at a chart like this. Okay, what matters is this here. This is reality. This is price. And I should, by the way, explain what this thing over here, you can see this is the straddle RV. The RV simply means the relative value. And I've got the formula down here. Relative value is just the straddle price. And just to kind of backtrack a little bit more, a straddle basically looks like a V shape. The expiration graph, when you put this thing on, the zero line would be something like this. And all you're doing is you're buying a call and you're buying a put at the same strike, this strike over here. And that is going to give you a ton of long vega. And you're basically hoping to ride that vega up. And but when you're looking to even between different earning cycles, what can happen is that if we look at the current earning cycle versus an earning cycle from, say, 2 years ago, the stock price 2 years ago may have been, let's say, half of what it is now. So therefore, in order to try to normalize the lines when you're looking at them, this is a way over here to try and normalize that. So we could just track the raw nominal straddle price, which is the call and the put. But now if the stock price doubles, then those options are going to increase significantly in price too. So then we'll have one line that looks, something like this, but then the other line when we draw it is going to be way up here. So it makes things very, very difficult to try and see on the same graph. So in order to try to normalize across all of the different earning cycles, what we're doing here is that we're taking that straddle price, but we're then dividing that by the stock price, the underlying. And by doing that, that gives us lines that are going to be much more neatly packed and tight compared through to one another. All right. So that is just what RV is there. By the way, as I go, feel free to ask any questions. Let me make sure I got my chat up here. All right. So if you want to ask through voice or through chat, that's perfectly fine. Okay. Look at my chat there. All right. Let's move on. So I don't mean to scare you with fancy formulas here, but this here is Black-Scholes, and Black-Scholes is pretty much the foundation for the math that happens behind the scenes in terms of pricing all of the options that we trade. And without getting too deep into the weeds over here, I want you to focus on this little guy here, which is like an O with a little squiggle on top. And what that is referring through to is the actual implied volatility. And so over here, you can see that we've got that there, we've got it here, we've got it here. And then these things, the D1 and D2, they actually go in through to the one above, right? So D1 is this one here, D2 is that one there, and so on. And so D2 is and D1 are used to derive the pricing for a call option. And then you can see here, both D1 and D2, which come from down here, are used also through to price a put option as well. So if we're looking at this and we now come back to trying to have an understanding of what IV is, and we now understand that IV is just the symbol over here, surely what we could do is simply solve the equation for that symbol. Okay, and now figure out that IV should be equal to some fancy formula, and then we add in all of the values into all of these variables over here, and then that should give us the IV. Well, unfortunately, these formulas over here, I think of them just as being kind of like too complex. We can't just solve for this particular variable. There are multiple ways to obtain that number, and that is the implied volatility number that we all see on the option chains, right, for every single strike. But we can't just solve for it by reordering these equations here. So what happens is that you've got to go through any one of these methods over here. Certain brokers can use one method or a different method. There's no one kind of perfect answer, but this is what you're using to arrive at the implied volatility. But let me try and simplify this thing for you. And what we know is this, which is the price of every call and the price of every put. The market determines that price just through supply and demand. Okay? Someone might say, I'm willing to sell this at this price and no less. Or someone is willing to say, I'm willing to pay this much and no more. So the market determines the prices of every single option, not the other way around. So some people think that IV magically just exists, and then this is the thing that is derived, the call and the put prices, and then that is what you see in the broker interfaces in terms of the prices that are shown. It's not that. It's the opposite, okay? The market determines these things over here, and then from that, we derive the implied volatility. But like I said, we can't just solve for this, so we have to use any one of these methods over here in order to figure out what the implied volatility is. But let me simplify that. And so what happens is that if we know that the price of a call, a particular contract is, let's say, $2 for that particular call contract, what we can do is we can say, you know what, let's just plug numbers in, just randomly, pick something. So let's say 15%. And this we replace these symbols over here with 15%. And then we figure out what comes out for the actual call, okay? Because we plug in 15 here, then D1 is fed in through to here, D2 is fed in through to there, and from there we can actually derive what the call option contract should be priced at. Let's pretend that what comes out is $1. That's telling us that this number over here that we use for IV is too low. So what do we do? Let's choose another number. Let's say 20% now. So we plug that number in through to here and here, and here, and that makes D1 and D2, and then we figure out what the call should be priced at, and now it's priced at 150. We're closer now to what the market says this price is. Not what it should be, but what it is. Because remember, the market determines that price. So we keep going higher, and now we say 30%. And when we plug in 30%, and follow that through the thing, we then arrive at $2, a perfect match through to what the market says the price is. So guess what? This is now the IV that is shown in your options chain. Okay? And here we just used it by randomly picking numbers and trying to get closer and closer through to the actual price. And that is all that these fancy things over here are doing, just doing it in a mathematical way, let's just say. Okay? But that is the process that is followed. So you start with the market determining the price of an option, and you then derive what the IV is based on that price. Okay? Not the other way around. And that is a really important point to internalize.
Question
So,
for you.
sure.
Does that are the implied volatilities in your brokerage firm determined this way?
Yes, absolutely. Yeah. So now remember, they can be using any one of these methods to derive the IV, but you still land at the same derivation. You know what I mean? So like based on the prior example there, we found that 30% was the right number, where if we used an IV of 30%, that leads through to a pricing from that options formula here of $2. And the market was telling us that what the market price is for that thing is $2. And therefore, we now know that we've got the right IV, which is 30%. Okay. So each one of these models here still arrive at the same endpoint, which is the derivation of IV being 30%. So then that is what is going to be shown on your options chain. And therefore, it's going to be the same across all the different brokers there. Okay, there can be sometimes slight variations between certain brokers for certain ones, things that are in this formula over here. There are elements such as the risk-free rate and so on, and different brokers can sometimes choose different forms of working out what the risk-free rate should be. And therefore, you can actually get sometimes differences in what you see with the IV being represented from one broker to another. So, but those differences are typically going to be fairly small. But there can be slight differences from broker to broker. And that's not that one broker is so-called correct and the other one is incorrect. It's just that one is using a certain type of risk-free rate. Another broker may not be considering dividends impacts because there's Black-Scholes and there's also Black-Scholes-Merton. And the Merton variation over here takes dividends into account, whereas the standard Black-Scholes does not. So there can be slight differences between the IVs that you see from broker to broker, but in general, they're going to be quite close.
What about the three different prices that you have for options? The ask and the bid and the actual most recent transaction. How do those plug into the implied volatility?
Sure. Well, what you'll find is that there are going to be buyers and sellers, right? So you've got your bid and your ask, and I guess you've got a mid here as well. So in terms of the pricing of this one over here is going to be a bigger number, and this one over here is going to be smaller. Okay. So what's going to happen is that the people that are bidding, as in they're saying, I'm willing to buy, but at a maximum of this particular price, are going to be on this side. And the people that are selling are going to be on this side over here. Okay. Now, some people mistakenly think that the mid price is a real price that exists here, and that is the so-called fair price. That's wrong as well. The mid is literally what this thing here says, which is it's the midpoint between the people bidding and the people asking. There's no such thing as this being a real or a fair price, right? It's just that you hope that you'll get filled somewhere in there, and it'll hopefully be somewhere around the mid, but you have no idea. You could get filled right here, or you get filled right here, and that's what the market gives you. So therefore, that is your price. There's no such thing as it being fair or unfair. Okay. So I've told you that you start with price and IV is derived. So in theory, if the bid and the ask are going to be separate prices, which they are, the reality is that you will actually have an IV for the bid and IV for the ask. Okay. Now, your broker typically is not going to bother doing that. And most of the time, the broker will figure out the mid price and they'll display the IV of the mid price. Okay, so you only see this typically on your broker, but the reality is that this is real and this is real. The mid is kind of like fake or derived is probably a better way of explaining that. Okay, so these are the two things that are real. Does that explain that, or is that not clear still?
Yes, thank you. That was
good.
I think you have a question in the chat.
For the price of a call or put to use mark to mark. Yeah, remember some brokers call the mid the mark as well. But remember, the reality is the bid and the ask. The mark or the mid is simply the midpoint between these two things and is typically what is going to be displayed within your broker interface. But it's more or less what I've just explained. You'll have an IV here, and then they'll basically figure out what the mid price is based on the bid and the ask, and then they'll run it through the same formula that I just showed in order to figure out what the derived IV is for this particular mid price. But the reality is that the market exists here and here, right? You then have to try and negotiate a price somewhere in the middle over here until you get filled. Most people think that they'll get filled at the mid, but no, sometimes you'll get filled here, anywhere in between. Okay. But the key thing that I want you to understand is that the market determines the price, not fancy formulas. Okay. The fancy formulas is what then derives the IV that you see displayed. But that is the order. Some people think that you start with the IV and then that determines the price. It's not the case at all. It's backwards. Market determines the price, and then we figure out the IV. Okay? Which is what is being said here. Okay, so these are all the fancy different ways to quickly get to that IV number, but you could, in theory, just randomly pick a number and then get closer and closer to what the market price is, and then from there you'll get through to your IV price, or the IV derived value, like the 30% that we talked about before, matching the $2 for the call. All right, so that was point number one. Here's point number two, and this is a really important thing to internalize too, okay? So what we're going to do is we are going to start off with a price for an option. Doesn't matter if it's a call or a put. Let's say it's a call. And a particular contract at a particular strike is currently worth $10. That's what the market is telling us is the price for that. No such thing as fair or unfair. It's just what the market is saying is the price. That's the reality, right? So we've got that. Now, as you guys know, as with an option contract, as time goes by, you get decay of that contract, right? So you can think of it as your theta, which is, time value decay. Perfectly fine. But just in generic terms, that thing that you've purchased, it's like buying an apple, and after it's been in the fridge for, a month, it starts to go rotten, right? It decays. So that is what's going to happen with the actual value of this option contract. Now let's pretend that the IV, when it's at $10 here, is 15%. Now we then go back through to our fancy formulas over here, which is all this Black-Scholes stuff. And then using those formulas, we can basically say, all right, what is going to happen after, let's say, 5 days? So after 5 days, what the Black-Scholes formulas tells us is that if it's currently worth 10, 5 days from now, it's going to be worth 7. And then we say, okay, what's going to happen 5 days after that? Well, it keeps decaying. So the fancy formulas tell us it's going to be worth 5. 5 days after that, it's going to be worth 3. This should all hopefully make sense, right? Like, yes, we know options decay in price, right? So what is this light bulb moment that you're alluding to? Okay, well, reality sometimes doesn't match what we think. So this is now what happens for real. So now what happens, and now we're talking about pre-earnings, okay? I'm trying to marry this theory now with what our focal point is going to be. So we start off with the price of the option contract being $10. So let's start at the same point here. So the actual is matching the actual prediction. But then we said that 5 days later, our fancy formulas from Black-Scholes told us that that option contract should be worth 7. But what's going on in actuality? In actuality, it's currently worth 9. Now, remember back through to where we started with Black-Scholes formula, where we started at $1. So in other words, we started with an IV of, I think, 15%, and then we worked it through the formulas, and that said it was only worth $1. So what do we have to do? We said, clearly that IV number is wrong. Let's bump it up through to IV being 20%. And then we got to $1.50. It still wasn't enough. So we bumped it up through to 30% or whatever I chose, and now it got through to $2. Okay? So the exact same thing has to happen here. So now what happens is that if we started off with 15% being the IV that was derived based on the price of being $10, 5 days go by, And the fancy formulas tell us it should be worth 7, but the market tells us, no, it's worth 9. So what do we have to do? The same thing. So we say, okay, well, if we increase the IV to 20, what happens now? And now it matches 9. So now we're good. And we say, okay, great. 5 days go by, and then our prediction formulas are saying it should be worth 5, but the market is saying, nope, it's actually worth 8. So guess what? We're going to bump up the IV again in order to make a match. And now we're good. And then 5 days later, fancy formulas told us it should be worth 3. The market tells us, nope, it's actually worth 7. So what do we have to do? We got to bump up the IV again. So guess what's happening here? The IV is increasing as time goes by. Think of pre-earnings now. Okay, let's say that the earnings event is here. So 15 days ago, it was 15, IV was 15%. 10 days ago, it's up to 20. 5 days ago, it's up to 25. Now, 1 day pre-earnings is up to 30. So that is in line with that IV graph that we saw, where it's just going to the moon. It's skyrocketing, going higher. But what's happening with price? Price is going down. It was at 10, then was at 9, then was at 8, then was at 7. So now we get a downward slope for price, which is reality. This is what we trade. We buy and sell stuff, the contracts. Yet the IV curve is telling us the IV is going to the moon. You get it? This is the discrepancy. This is the exact thing that we see in those graphs that we looked at before. Let me go back again and show you the graphs, right? This is IV going to the moon. This is the reality of prices of the actual straddle, which are decaying. So if we bought a straddle here and we sold a straddle here, we have lost money. We've not made money, even though this thing is positive vega.
Another question.
Sure.
There are other confounding factors, and that is the price of the stock also could have been changing in this time. So in the prior slide where implied volatility was going up, but the price was going down, but more slowly than it should have been, that's assuming all other things are equal, right? The prices otherwise.
That is correct. Okay, but the thing is, this effect has massive power compared to even price. So you'll find that even if the stock, for example, normally if you see the stock price, let's pick the easy one that everyone knows. Stock price is here, and then suddenly you get this kind of thing where prices come down hard. What happens to IV normally? Outside of earnings.
Goes up.
Goes up, okay? If you're here and this thing goes significantly higher in price, what typically happens with IV?
Goes up.
No, it crushes. Right? With a move higher, IV crushes. With a move lower, in the underlying, IV spikes. Think of IV being like fear, okay? So if this goes down, the fear increases, so IV rises. And if this is going higher, the fear decreases because it's greed, not fear. And now IV crushes, okay? This is what happens normally outside of an earnings event. But during pre-earnings, this factor over here that I'm talking about, the relationship between IV and the price, in particular of the straddle, is massively powerful. It overpowers all of this because you could actually get the stock doing whatever, and it barely changes these graphs here, and you'll see that in examples that we step through today. So you're right. There are many factors in here. You can see that there are a whole bunch of factors when it comes to option pricing, but this concept here of understanding the difference between IV and price is absolutely key and massively powerful. The effect itself I'm talking about. To the point that it tends to override all of the other stuff, mostly. Any other questions there? No? All right. Okay, so hopefully now you understand why we see this effect of IV going to the moon pre-earnings. And by the way, most people may just be looking at this, and that's all they look at. They don't realize that this is reality, and then they wonder, why the hell isn't my straddle making money? It was long Vega, and significantly long Vega, and IV went to the moon, right? But hopefully now you get it. Okay. Here's a little brain teaser. So this effect that we see here is very, very clear during pre-earnings, okay, of IV going to the moon and the price is actually going down. Can anybody think of another example, which happens far more frequently than earnings, which happens every quarter, right? Can you think of any other example of the same type of effect? I'll give you a couple seconds, see if anyone knows. Most people don't, so don't feel bad if you don't.
News.
Yeah, you could think of, so if you're talking about like a Fed event, we know that a Fed event that is could come out with news that moves the stock significantly up or down. That therefore behaves very, very similar through to an earnings event. So that is correct. Okay. Like a future earnings, a future news date, for sure. That can act like an earnings event. Anything else?
Zero DTE.
In what way? How are you seeing IV being different from the prices? Like this type of effect is what I'm talking about here. Where IV increases, yet the prices actually go down. Most gurus that you'll see on the internet basically think of IV being tied to value. So if IV goes up, they say that clearly what's going on is that people are buying that particular option contract. Okay, and therefore that increases the price, and because the price has increased, IV has gone up. That's actually not, it can be correct, but it's not always correct. And during pre-earnings, it's definitely not correct. It's completely wrong. Okay, and that is kind of like a hint of the actual answer.
I think you had a couple of chat answers, which might be getting at what you're talking about.
Yeah. Most people here are saying the Fed event, which is correct, which is very similar to earnings. Tim here said dividends, and then we've got some other people here saying market crash rates and so on. Yeah, I mean, you're
FDA announcement.
Sure, any type of future thing that is going to be announced that could affect price is going to behave very similar to earnings. That's exactly what earnings is, right? So anything that falls into that category, yes. But you'll find that there's actually something that happens pretty much every single day that you just haven't noticed, but it's there, right? And that's what we're going to see here. So where this effect happens all the time is when we're talking about far out of the money options and when there's not too much time left through to expiry. Okay, so here's the same kind of scenario. So let's say that we started with an option contract that was worth $10. Time has gone by and maybe the underlying has moved and what have you. So therefore that same contract now is down through to being having a value of 20 cents. And let's do the exact same thing. So from here, let's pretend that the IV is currently 15%. Fancy formulas tell us that after, let's just call it 1 day, because now we're fairly close to expiry. So instead of doing 5 days, let's just do 1 day. 1 day later, the fancy formulas tell us it should be worth 13 cents. 1 day later, it should be worth 7 cents. 1 day later, it should be worth 2 cents. Okay. The reality, though, is something like this. So we start off with the same value on the same day, but then it's now decreased through to 15 cents, which is higher than 13 cents, which is what the fancy formulas told us. So what do we have to do? Just like before, we've got to bump up the IV in order to make these values match. So now IV has gone up, but the price has gone down. Then after that, after another day, price decreases again, but it's gone down to 10 cents, whereas the fancy formulas told us it should only be worth 7. So now we're going to bump up again. And then we can actually get in through to, especially during the final few days before something expires, especially if it's far out of the money, we can get the market, because remember, it's the market that determines the price, okay? And the people that are willing to sell an option contract are saying, you know what? Once it's worth 10 cents, sometimes 5, but let's just say 10, they're just not willing to go any lower. They're not willing to sell something for less than 10 cents, no matter what, no matter how far it is, no matter, like they're just not willing to go cheaper than 10 cents. So they just stick to that price. And they say, I'll sell it, but at no less than 10 cents. But now that screws up Black-Scholes, because Black-Scholes says, no, it should be worth 2 based on my fancy formulas. So now this has to increase to 30%. One day after that, the market still says it's still worth 10 cents. And now Black-Scholes says it should be worth 0.01. So now it's 40% IV, and so on until it expires. Okay, so the market will get down through to a base price, and they're not willing to go lower. But Black-Scholes says it should go lower. Options decay. All right, but then in order to make it match to reality, they have to keep increasing the IV. And this happens every day, and you've just not seen it, or at least not had that light bulb perhaps to realize it the case. So this is real option chains here. You can see, look at this, all right? The amount of strikes that are all priced 15 cents, all of them, and then the amount of strikes over here that are priced all the way up through to 10. And they're just not willing to go any cheaper than that. So as this thing decays, this is why you then see the Black-Scholes IV increasing higher and higher and higher and higher and higher. Yet the price is staying flat. It's not changing. But Black-Scholes is saying that's wrong, right? The option contract should be decaying, but it's not. So you fix it by increasing the IV, right? And you can see that here. This is in Option Net Explorer. You can see this is at 4 DTE, this is 5 DTE, and then 6 DTE. And then if you choose, say, a row like this, the 7300 strike there, notice that when it's at 6 days, it was worth, sorry, I'm using the wrong one here. The price, that's the mid, is 5 cents at 6 days. It's 5 cents at 5 days. It's 5 cents at 4 days. It's not changing. They're not willing to sell it for less than that. Okay, therefore, the IV has to keep getting higher and higher. Look what's happening here. The IV here is 13.51. Then it increases to 14.8. Then it increases to 16.5. Does this mean that there's more demand because the IV is going higher? Does this mean that the value of the option contract is going higher? No, the opposite. The option contract is staying flat, or could even be going down. But the IV has to compensate in order to make the Black-Scholes formulas match reality. Okay. This is another view of the same thing. So if you look down here, you can see that this is 9th Feb. Then we've got 12th Feb, 20th Feb, 20th of March, and April out here. Okay. So we basically, these lines down here are further out in time, and the ones on top are closer and closer to time. And now if we choose any strike, say the 4000 here, and look at what happens, look at and this is IV over here. This is the IV at a certain amount of time out. And then as we get closer in time, IV increases, then it increases, then it increases, then it increases higher. Across every strike, you can see the same effect. Does this mean that more people are buying closer dated options than further dated options? No. Okay. Now, some of you are going to say, well, I've heard 0DT is very popular. Yeah, but this effect has nothing to do with 0DT. This happens across every expiration. Right? But it's about understanding how those two things interrelate. It's got nothing to, like, I've seen some gurus out there basically say, when you see a skew curve that looks like this purple line, this means that this option over here at this strike is more valuable than this one over here because the IV of this one is lower than the IV of that. That is just completely wrong. Okay? Doesn't work like that at all. So this effect of the lines getting steeper and steeper and steeper has everything to do with the decay effect of what I've just explained to you. So the prices could actually be going down, not up, but IV is going higher because Black-Scholes expected the price to be much less than what it actually is. And the market is saying, no, I'm only going to sell it at this price. So therefore, Black-Scholes has no choice but to increase the IV to make a match. All right, Peter is saying markets are very thin, blah, blah, blah. Yeah, sure. Markets are going to be very thin the further out of the money you go. And sometimes you won't even find any bid prices there at all. That is separate, though, from the effect of what I'm talking about. The effect is still real. The effect still happens across the entire chain. It's just easier to see it when you get further, very far away. It makes the effect obvious to see it. But you could see here, like anywhere you go, like if you go at here, the effect is still the same. The lines get steeper the closer in time you get. It still happens at this strike. It still happens at this strike. Still happens at this strike. Happens everywhere. Okay, the effect is real. Cool. So that is a really important thing to internalize in order to understand why you can put on straddles or something that is long vega. Some people like to do, long calendars as an example, and lose money. Okay, even though you're positive vega and you say IV went up, why didn't I make money? It's because IV is derived. What matters is price. All right. So hopefully that's clear. All right. So now moving on through to actually trading this stuff. You can basically trade earnings almost throughout the entire year. That there are things that you can trade from an earnings perspective almost at any time, but the vast majority of, especially the larger stocks, are going to have 4 periods, which basically coincide with the quarter reporting results, where the majority of them tend to report and have the earnings event during roughly about a 1-month period. Okay, so mid-January through to mid-February, that's the Q4 results. Mid-April through to mid-May, Q1, and so on and so on. So these are essentially like 4 monthly periods throughout the year that there's a ton of opportunity to trade earnings events there. Literally a ton of them, which I'll be showing you some. But you can also find some other opportunities outside of these 4 months as well. Now, as I've mentioned to you before, you've got 3 broad categories. You've got pre-earnings, you've got earnings, and you've got post-earnings. I consider this middle piece here to be far more on the gambling side of things than the trading side of things. So, but there are still ways to do that more kind of like from a quant or data perspective. But many people here just say, you know what, I'm going to more or less gamble it and say, I'm going to put on the straddle, as in a short straddle, because they want short vega, because they think there's going to be a huge vol crush, and therefore that is the obvious trade to put on. And as long as the stock stays somewhere inside of this tent, then you're going to be okay. But if it moves outside of that tent, or basically outside of your break evens, then because the zero line is there, then that's where you're going to be losing money after that, right? So I personally do not like the short straddle at all. Why? Because this thing here has unlimited risk on both sides. So I don't like that at all. So even though it's probably the most popular earnings trade to put on, I'd never do it. Other options that may look weird to you here is that notice that I'm saying a long calendar or a double long calendar here. You say, hang on, a long calendar has long vega, positive vega. Why the hell would you do a long vega trade when you're expecting a massive IV crush? Well, that would be a good question, right? And you'll see that surprisingly, you could actually put on these long vega trades during this earnings crush event and still potentially make money, right? Which throws a lot of people. And we can look at some of these examples as well. And then we've got the post-earnings event, which I rarely trade, but you could do various types of things. I've talked about doing the iron condor there, so you're basically just bracketing price. Sometimes you can get, especially if price was here and then you get a move up, and after the earnings event, it's up here, you can get something called a gap and go, where price a lot of the time will do this kind of thing, right? So things will jump up. If you just think about it just in general terms, people say, why did price go from here to here? Typically, it's because they had good things to report on during the earnings, and then they said, sales went through the roof and blah blah blah, and everyone says that is a sign that this is a great company, they're doing really well, let's jump in, and then we get more and more people buying, and this thing keeps going higher. Okay, so you can absolutely do verticals there where after the earnings event of things that have gapped up, you can basically just do like a put credit spread here, either at the money or slightly below the money, on the expectation that the stock is going to keep going higher, and you make money from a directional move now. So that's a pretty common thing for a gap and go. Iron condors, typically you're going to do those when there's a big move down, because a lot of the time when the stock was here and then there's a big gap down and now it's trading down here, people sometimes need some time, typically at least a few days, to digest that information and say, why the hell did the company, gap down so much? And there's, fear. Should I jump in? What if this thing continues down and whatever? So sometimes for a few days, you can just get sideways chop, and that can sometimes be an opportunity to try and bracket that price move. But in other instances, what will happen is that you'll get a big gap down, especially if it's a large company, and you can go back to just a few years back now, and we've seen this both with Facebook and with Google, where they went down close to about 20% on a earnings event, and then we had a whole bunch of people that said 20% down, thank you, I'm buying the dip, and then you get like this V bottom kind of thing, right, where price can go up. So different things can happen. It's not as predictable, I think. So therefore, that tends to be why I most of the time I tend to not focus on this. I don't focus on that. Definitely not with short Vega trades. I'll sometimes do calendar trades here, but my preference is here. In my opinion, this is where the better edge, statistically speaking, is. We do get this effect with IV, but remember, that's not what matters. What matters is price. But I do like doing long straddles in particular, because I also trade other things in my account, so-called income trades, if you want to call it that, with options. Think of things like broken wing flies and so on, and those are negative Vega trades, and also have negative gamma as well. And so in other words, the trade will look something like that. But now your T0 line is kind of doing this kind of thing, right? And the negative gamma means you've got a curvature that curves down like this, whereas positive gamma would be like when you put on an actual straddle where your T0 line is like a U shape. So if you've got curvature that curves up visually, that is representative of positive gamma. And when you've got a curve that goes down like this, that is negative gamma, okay? So if you've got trades on like this, and the market is currently here, what you don't want is you don't want to wake up to the market coming down 20%. So think of an event like 9/11 or something, like some big emergency, major war or dirty bomb going off somewhere. So what you could do is you could pair that with doing these pre-earnings trades, where you're putting on a lot of these straddles or strangles. And now what happens is that these things over here basically act as like a hedge to all of the income trades that you've got. And normally when you put on a hedge typically costs money out of pocket, and it's normally money you have to kiss goodbye. Just like when you buy your car insurance, you're paying your car insurance without an expectation of getting a net profit out of it, right? It's a loss, but you still do it. And so in the same way, when you're buying hedges for your options strategies, normally it's just money you kiss goodbye. But just like with car insurance, you want to be protected in the event of you crashing your car, and the insurance company will give you a brand new car at the end of that. So in the same way, if the market crashes, you want to be able to now cash in on your hedges, partially so that you can compensate your losses that you're having from your option income trades. So that is part of the reason that I like these two things working together. And if I can get to a point where my hedge, which normally is money you would have to kiss goodbye, if I could actually have hedges on that bring profits in, damn, I'll take that every day. And that's exactly what we see here. Okay, so by the end of today's session, I'll show you exactly how I trade these pre-earnings long straddles, and they essentially act as not just even free hedges for my income trades that I do, but it actually brings money in. Okay, so it's a profit producing hedge. So to me, that is best of both worlds. And if I'd be perfectly happy, even if I'm just breaking even. Okay, if one long straddle makes 10%, the other one loses 10%, fine. I'm not making money, but guess what? During that period, I've had protection in my account for free. Right? Long calendars is something popular again because it's long vega here, and long vega, I should say, and long calls. This is going, and verticals. These two things over here tend to take into account. You can get like a run up into the earnings event. There are some stocks that just have this as part of their normal pattern of price of the actual underlying. Okay, so a couple of weeks prior to the earnings event, typically people come in and buy that particular stock. So you get the run up in price, which is a directional bet that you're placing. So these two trade types here are to take advantage of that type of effect. All right, but my favorite by far is this. And sometimes I'll do strangle instead of a straddle. So just to clarify that, a straddle is where you buy a call and a put at the same strike, like that. And a strangle is going to look like this, where you're buying like you're buying a put typically here and a call here at slightly different strikes, and that just widens out this base kind of thing. But the only reason why I would do a strangle is if when I try and simulate a straddle here at the money straddle, if the position is showing too many positive or negative deltas, and then if I go to the neighboring strike and I put on a straddle there and I still get the same thing where it's still a bit too positive or too negative, I'll just split those two strikes out into a strangle, which looks like this. So there's only one strike between these 2 points here. It's not a wide strangle. It's a very, very narrow strangle. But I'll only do that so that my deltas at initiation are flat. Okay, I don't want to be directional for these trades. I just want to take into account the effect of not the IV increase, but just looking at raw data of prices. Okay, and if you're not using specialized tools, you want to have access to that in terms of what happens with prices, not with IV. Okay, because what matters is price. So let's start getting into that. Long straddles. So the primary tool, I'm going to show you a couple of different tools that I use here, but the primary tool that is essential really is called Market Chameleon here. And what I'm going to do here is I'm going to go through to the earnings tab, and then I'm going to select earnings option strategy scanner. From there, I'm going to go to my predefined filters. So you can create as many different filters as you want. And from there, you can see all of the orange stuff here are things that I've essentially turned on, and I then save to my, if you've never created that before, you're going to click on this button over here to create a new entry in your predefined lists. But from that point, once it's done, you simply go to the drop down, select your predefined filter. And in this case, I've called mine just long at the money straddle. And then it's automatically going to fill in all of these criteria that you've got here. So let me explain that. First thing, market cap. I don't want little tiny stocks, so I want a market cap of at least $1 billion or higher. Then I'm going to tell it I want to focus on long at the money straddles. And if I click on this drop down, I'll show you this live, but they have a ton, like dozens of different strategies that you can select. But here I'm just I'm staying focused on at the money straddle. So here, the earnings date, I'm saying within the next 5 business days, and I want this to be confirmed. This is important too, right? Let me give you an example here. So let's pretend that this is just time here, and let's say that the earnings event is here. But let's say that we are, I don't know, 2 months away currently. So we're currently here and we're 2 months from this supposed earnings event. So you say to yourself, okay, if this is the earnings event, then I'm going to set up a straddle in an expiration that's just behind the earnings event. And I'm going to put on that straddle. Okay. But then what happens is that, time starts going by and now we're here. And then the company says, you know what? Sorry, we had to move the dates and whatever. The actual earnings event now is going to be here on this date. Guess what happens to the price of this straddle? Okay. It gets crushed badly. So you don't want that. So what you want to do is you only want to place your straddle in the expiration immediately behind the earnings events, only once the earnings event has been fully confirmed by the company. Okay, as in it's fixed. It's not going to move. All right. So that is what's happening here. So we're saying it must be confirmed, and it's the earnings date should be happening within, let's say, the next 5 days. And these you can tweak these if you want, but I'm just showing you what this current filter is currently at. Then for the historical open and close range, for the open range, I'm basically saying I don't care where the strategy is going to be opened. If it's going to be open 5 days before, 3 days before, 10 days before, I don't care. All I care about is that the historical closing range is 1 day before. And in Market Chameleon, when they say 1 day before, what this actually means is that it's the final point in time where you can place a trade before the earnings event. Okay, so because you'll know that there's two types of earnings event or the report. You've got the after the market close and before market open. Okay, and you'll see this literally listed like that, BMO and AMC, right? That's what these things here mean. So if I say 1 day before, and this is, let's say it's for today's Monday, right? So let's pretend that it says it's the earnings date is for Monday, but after market close. That means that I can place my trade during all of Monday, and as long as I do that, then I've avoided that earnings event because the earnings event is going to happen after the market closes. Okay, so when that happens, 1 day before is actually going to match through to Monday. But if the earnings date is also on Monday, but it's a BMO, if it's before market open, that basically means that my last opportunity to place a trade is not on Monday, but on the prior Friday, the prior trading day. So therefore, when I say 1 day before, the date that would come up here would have been last Friday, not today, not Monday, even though the earnings date is on Monday for both, if that makes sense, right? So the nutshell is if you set this through to 1 day before, that simply means that it's going to be the final date at which you can place a trade before the earnings happens. All right, so that's that. Then for number of observations, because this is a database that has millions of entries in it, tracks every stock, every earnings, basically for many years going back. And what I'm saying is I want at least 5 observations. So since companies report every quarter, that's saying 5 of the prior quarters must be there in order for me to want to see the result. Excuse me. Then I must want to see at least a 50% win rate. A lot of the time, actually, recently I've changed this over through to 70. You can tweak these as you wish, but if there's a lot of opportunity there, why not select even better criteria, right? So do either 50 or 70 there, up to you. I'd say probably do 70 at the moment because we're still in that big earnings cycle. Then for the average and for the median return, I simply want to see anything positive for the average and for the median. And then for the Sharpe ratio, which is a form of risk-adjusted return, I want to see a Sharpe ratio above 0.5. Now, a lot of you might say that, well, it's a pretty sucky Sharpe ratio, right? 0.5. I've heard that Sharpe of 1 or higher is better. True, but these trades typically just last 1, 2, or 3 days, and you're not going to find Sharpe ratios being super high with this style of trading, right? So you just got to take what you get. So I normally set this at 0.5. So that is my criteria. From there, I get a list of results down here. And normally the types of things that normally I will then do a sort by Sharpe ratio descending. so that this brings all of the best performing stuff through to the top. So I'll see the 1.63, I'll see the 1.03 and whatever, going down. And then I can start reviewing my trades from top to bottom, and they should, roughly speaking, be from best to worst, okay, out of that particular short list. And then I'll explain all the other stuff here, but actually maybe I'll show it through here. So you can see they're all going to be long straddles. It's saying that historical open range for this particular trade is we open 3 days before. All of them are going to be 1 day before, because that's what we said over here, right? So we exit just before the actual earnings event, but you can see that it's since I didn't limit the open range to anything in particular, I've got 3 days, 1 week, 2 days, 3 days, 2 days. Doesn't matter. I don't care. Then number of observations, I've said I want at least 5 there. So you could see here, obviously, if I have more observations, that's my preference. I want more data rather than less data. Then you can see the win rate over here, which is definitely something that I will eyeball there. And I mean, look at some of these, right? Like you've got 99% win rate there, a 90% win rate with 10 observations. That's pretty damn good. Then average and median return. Normally, I will tend to not really focus on average return. I will tend to focus on the median return, right? And the reason for that is because the average can be swayed by a big outlier event. And I just want the middle result out of all of the events, not the average, right? Which is easily swayed. So I'll tend to focus on the median return over here. And typically, if I'm trying to do this to try to make money, I'll normally want this to be above, say, 5% or so. And remember, this is 5% in 2 or 3 days, okay, which is pretty good. And so that would be that. And the best and the worst, I'm not really particularly focused on. But what is interesting for you to look at over here is that notice that when you look at this, and you can look at very, very long lists, most of the time you'll find that the maximum drawdown that you'll see on your investment is about 20%. It's extremely rare to see numbers that are lower than that for a pre-earnings straddle. That's only a few days from expiration. Okay. So that is important, and we'll get to sizing in a second. For a Sharpe ratio, this is really just risk-adjusted returns. So the higher this number, the better, and that's why I sort by that. Then over here, we've got the actual earnings date. So tells you the actual day and if it's before market open or after market close. Then this number over here means how many days until that earnings event actually happens. This thing over here says how many days until I can open my position. So notice that this here basically says you enter this 3 days before the earnings event. The earnings are in 3 days. Therefore, today is the day to enter. So if it says 0 here, that means these are opportunities that I should be entering today in the market. Now, if the market's already closed, as they are right now, then I've already missed out on this. Okay, so I'll start focusing on the stuff that I can do tomorrow. Right. Days to next close. This is just telling you that you're going to be in the trade for 2 days after today, and the actual date where you can see the actual date that it's going to be open and the date that the trade will be closed. And this is an important one to confirm as well, because you want to check your calendar, make sure that you're going to be available, that you don't have, a kid's recital or an appointment at a dentist or whatever, that you'll need to be able to be in front of your computer to close out your trade, right? Or that actually it's a holiday. So that was the other thing that I actually woke up this morning going, oh, hang on a sec. Like, am I absolutely sure that today's markets are open because it's President's Day? But it is. And I did have to close the straddle out today. All right, so that is what all of the numbers mean. Then, if you then go over here and you click on any one of these number of observations, that then will expand out through to something that looks like this. That it's now showing you the full details of every one of those prior 5 observations. So the first thing that I tend to look at is the return. This is the return of the strategy. In this case, it's a long straddle. And you can see it made 1.7%, it made 10%, 3.7, 6, and 10.6. No losers, but it's only 5 observations. Does not mean that it's never going to lose. Of course, the chances are that it could lose. But in general, remember that, especially when you eyeball the full list of, let's say, 10 observations and what have you, remember that on average, you're not going to see a loss, typically less than 20%. And that is how I would recommend that you size things up. So I think I may have a slide on this later on, but I may as well cover it now. So what I'd recommend, like with anything, is that you start trading this relatively small in size until you get practice. And then once you get practice, you can start building up your size once you feel confident. But as an example of what you could do is you could say, all right, how much money am I willing to risk? Make that number be relatively small. Let's say it's actually, you'll see me doing exactly this in my examples. I've basically said, all right, I'm going to risk $200. I'm willing to lose $200 if the trade's a loser. And then from a sizing perspective, you say, all right, since I know that on average, the max loss for this type of trade is going to be about 20%, you could use that in your sizing. So you could basically say, all right, if $200 is going to be the loss that I take, and I do take a loss of 20%, what you could do is you could divide by 20%. All right, and also here. All right, so you get your trusty calculator there. So you say the amount of money you're willing to risk, you divide that by 0.2, which is your 20%. And that's telling you that you can essentially buy a straddle where the deepest point of the straddle is going to be $1,000. Okay, when you look at a risk graph. So in other words, you're spending $500 on a put and $500 on the call. Okay, so your total max Reg T risk there is going to be $1,000. And if you lose 20%, then that's worth $200, which is what you're willing to risk there. Now, if you're willing to go more aggressive, you'll find that most of the time, your losers are going to be closer to the 10% mark than they are the 20% mark. So if you want to be more aggressive, you can do exactly that. You can basically say, I'm willing to risk $200. Most of the time, that loss is going to be representative of a 10% loss. And that then now tells you can, the deepest point of the straddle can be $2,000. In other words, spending $1,000 on calls and $1,000 on puts. And on average, your dollar loss should be about $200, but knowing that every now and again you might get a 20% loser there. So every now and again you will have a $400 loss. Okay, but that is how I'd recommend that you size things. So just choose whatever numbers you're comfortable with, but use this concept in order to size your straddle, and keep the size consistent across all the trades that you actually do. All right, so here's an example here of a trade that I started towards the start of this main earning season, which is about a month ago. CNXC. This is just looking at the actual chain, and this is in Interactive Brokers for those of you that don't recognize this. And so I'm simply going through to at the money, and I'm buying a call. I'm buying a put over here. And you can see that this is building this thing up in this thing called a strategy builder. You can see it's basically saying it's a Jan 45 straddle. Then I can see my bid and my ask price there. And remember, what we're doing here is we're buying that long straddle. So since we're buying, you want to buy cheap and then sell high, right? So what I'll do is I will eyeball the mid, so I know what the mid actually is, but I'll submit my order at the bid price. And then I'll slowly walk it up, and I'll normally get filled somewhere between there and the mid, typically. Sometimes you'll have to go past the mid because the underlying, of course, can be moving around as well. And there's no magic that says that you have to be filled at mid, right? Sometimes you'll have to go beyond it too. But typically I'll get filled, somewhere close to the mid, but normally I do want to do this kind of walking towards the mid slowly and not being in a rush, instead of just submitting my order at the mid like a lot of people do. Because sometimes, as a matter of fact, very, very frequently, I'll get filled slightly under the mid. So therefore, I've made some money compared to the people that just submitted at the mid, right?
Question.
Sure.
How long does it take you to walk that price up to when it gets filled?
Okay. Normally, what I tend to do on a daily basis is I also give myself a limit normally of about 3 straddles that I enter per day. So what I'll normally do is I'll go through I've got almost like a 10-step process that I go through. And then with the final candidates, so let's pretend that I've got, let's say it's a good day and there are, 6 different straddles that all look good with all my criteria. I'll just simply choose the best looking 3 of them and submit orders for those. And I'll do one of those at a time. And then by the time that I've submitted my 3rd order, I'll then go through to there's like a panel over here that has all of the orders that have been submitted. And then I'll go back through to the first one that I started with, which has now been kind of like actively trying to get filled for, I don't know, 30 seconds maybe. And then I'll change my limit price up a little bit. And then I'll go to my second one, bump it up a little bit. My third one, bump it up a little bit. Then I'll typically wait like 15 seconds or so, and then I'll go back and keep doing the same thing until I get filled on all 3. All right. And the process from start to finish, normally it doesn't take that long. It's like within 5 minutes kind of thing, I'm filled on all of the straddles that I'm going to do per day. You can be more, if you want to be more patient and, really try and haggle for the price, that's fine. But normally with me, I'm in and out within about 5 minutes. Okay. So you can see here, so I started with the limit price here of 550, which would have been the bid at the time that I entered. And then started limit of 550, so 10 cents above the bid, and then incremented by 10 cents at each step until I actually got filled. And you can see that I got filled at $5.90 there. All right. Now, at trade initiation, this is what your straddle looks like. So notice that I'm buying a call and a put at the same strike. And we've got, that V shape that we saw before. And now this is your T0 line over here. And normally when you're looking at a graph like this is now telling you that if, because we were planning on staying in this trade for 2 days. Each one of these lines over here represents 1 day over here. So in theory, you should be saying, okay, the software over here is saying, if nothing were to happen and the only thing that happens is that 2 days of time goes by, we're going to be on the gray line here. So if price doesn't move of the underlying, I'm going to be losing $175 or $180. That's what the software is predicting. But remember, this concept of what I said before, of the fact that a certain thing tends to happen with prices, and then that is going to bump up the IVs. All of those things also then affect the Greeks, because the Greeks are derived after the IV. So it's like a second degree of derivation. And that is how the software then predicts how much this thing is going to droop based on theta and all that kind of stuff. But that is just not what is going to happen in reality when we're doing pre-earnings trades. This is what the software tells you, and it may look scary. You go, oh, I don't want to have to lose this amount of money just by not doing anything. But you'll see plenty of examples here that this is not what, the prediction is not what actually happens. Brandon says you get real quick fills if you accidentally start at the ask. Yes, and I just made a fat finger error just 2 days ago. So it happens to everybody, even though I've been trading for decades, So always take a breath before you submit the order. Make sure you're on the right side of the bid and the ask. Because what happened was that I was, the prior day, I had been selling all of these straddles to get out, and my brain was just in that mode. And now the next day, my brain was just in autopilot and just submitted at the ask just like I was doing before in order to get out of my positions. But now I'm trying to get into a position, and I'm going, why the hell did I just get filled so fast? I'm like, oh, you idiot. So, yes, we all make errors. All right. And then 2 days later, so you can see here, this is entry on Jan 8. And then this is exit on Jan 12. And but this is after a weekend, right? So obviously you can't trade it over the weekend. But look at the lines, right? Now, if I go back, the lines here said that 2 days of time going by should result in the graph looking like this at this droop level. But this is now 2 days later, and this is the line here. The entire line, no matter where you are in terms of where the underlying is profitable. Right? This is exactly what we want with these types of trades. And notice that I was not looking at an IV graph going to the moon in order to make this decision, because I know that that is completely wrong or misleading. Okay? The data that I need to look at is this. It's actual, not just raw prices, but these are actual straddles that were put on 3 days before and exited just prior to earnings. It's the exact trade that I'm putting on, and I'm looking at the historical data that tells me what was the P&L of every trade. That is an exact representation of what I'm putting on going back X number of cycles. Okay? But this P&L is based on actual prices of my straddle, not based on some derivation of IV. Okay? That's why that software is so important. Because again, if I'm looking at something like this simulation software is telling me you're going to lose money almost everywhere. But guess what? This is reality. I'm making money almost everywhere, not losing money almost everywhere. And during those 2 days, I had this beautiful hedge to the downside. So that if the market crashes, this thing is going to make a lot of money. Okay. So here's what it looked like at exit as well. So you could see the actual exact what the option chain looked like and P&L, whatever. You can see here, $109 profit here out of $590 of the risk down here. That's max risk. That's an 18.5% return. Okay, and again, I recommend you do exactly what I'm showing here, which is trade in small size as you get the hang of this type of trading before you ramp up, right? And this is the benefit of what I was mentioning before, that you, at any point in time when you're doing these trades actively, typically I will go into, normally 2 or 3 trades, as long as they're good picks to pick from, right? But normally I'll do 2 or 3 straddles per day. So I've got a whole bunch of straddles at any time, and then they're essentially my hedges, or one of my hedges. I've got a whole variety of different hedges that I teach. But this is a really nice strategy to overlay on top of your other option trading, because it basically acts not just as a free hedge, but as a hedge that pays you money. Okay, as long as you're willing to put a bit of work into this process. Larry says, would you have been able to get one to show the actual graph by making a vol adjustment in the dropdown? Okay, that's a good question, actually. So when you're looking at this, this software, like many other simulation software, has the ability for you to vol adjust. As a matter of fact, you would do it here. Okay, so could you vol adjust here by bumping up the IV, by looking at an IV graph as an example, and then getting a good prediction of what your risk graph is actually going to look like? Now, the answer to that is not really. And you may think that that's perhaps controversial, because what will happen is that if I bump this number up, these T plus X lines will go higher. So you might say, well, that is actually what happens, right? That's true. But the problem is the simplicity with which this adjustment is made. And what happens is that if I increase this by, say, 3 points, it will increase every single strike in the entire chain by 3 points. Now you might think, yeah, that's exactly what I wanted to do. But that would be wrong, because that's not real. Okay? What happens is that we have to get into another topic, which is kind of like a tangent, but something called skew and concavity as well. But the nutshell is that IV does not increase symmetrically across every single strike. IVs increase by different rates for different strikes. Therefore, when you're using this type of adjustment over here, you can get a very unrealistic prediction of what will happen. Okay? So I would not recommend doing that, even though you may think that that is a logical thing to do. The thing you want is this. You want real data that looked at real bid and asks, that looked at real entire positions, not just one particular strike, but your position, which is along at the money straddle, and real P&L at the end of it, and as much data as you can get. So, if I can get 10 observations instead of 5, fantastic. That's the one that I want. All right. But this is the actual data that you want, not option simulation stuff that's like this, and not by bumping up the IV manually, because that will do it equally across every strike, which is unrealistic.
Question?
Okay. Yeah.
How did you decide when to exit the position?
The software tells me. Let me go back. So you see here, it basically says because this has millions of entries in the database. And this is basically saying, I have 5 observations of entering 3 days before and exiting on the day prior through the actual earnings. This is what this row means. And it tells you get in on Jan 8, you get out on Jan 12. So there's no, I wonder when I get in, I wonder when I get out. The software tells you.
But
You're just going based on the actual data. This is what I'm saying. Like if I replicate that trade, hopefully I'll get something that looks similar to this. That's all I'm doing.
you have a choice of when during the day to exit a position, though.
Oh, I see what you're saying. Yes, this data is based on doing it very, very close to the close of the session. So normally I will do these trades during the final 30 minutes of the day in order to make it match the historical data. If I do it at the open, that I'm not trading in the way that the data has been constructed. The data has been constructed based on closing prices. So the closer that you can trade to the end of the session, the closer you'll be able to get to these numbers here. Okay. Larry says, okay, so you need an event that repeats. You can't say, I think some rare event is going to occur and use a strategy like this. Can you expand on that, Larry? What you mean? Because all we're doing here is we're simply looking at odds. It's like walking into a casino and they say, hey, we've got a table over here. And if you place a bet, here's the historical data of what the payout is per bet. 1.7%, 10%, 3.7, 6, 10.6. Do you want to play? That's it. That's all we're doing. I mean, you might say, well, that's gambling. That's just, okay, if you want to call it that, sure. But we're using actual data to make a trading decision. And that's it. These are my odds. These are my stats. I choose to play or I choose to not play. End of story. Larry says, so events are regular events with lots of history, but if I think some country is going to be invaded and vol spikes, then I have no history for that. Okay, I'm not sure if you're kind of mixing 2 different topics. So what I've just said here, this is just the nutshell of I'm using this data and I decide if I want to play this game or not. And hopefully when I place my trade over here, hopefully it's going to be relatively similar through to the historical events that I've got there. That's one thing. A separate thing that I was talking about is that, where's my thing? No. No, I don't know where my slide is. But basically the one that I was showing all the actual straddles. So what I'm saying is that if I've got a whole bunch of straddles, long straddles on, simply I'm trying to make money from these trades, okay? But let's say right now, if I have, say, 3 long straddles on, and the market now crashes 20% down, I've got a whole variety of other hedges that I use and I teach. But forgetting about all those, I've got an extra 3 long straddles now, where the risk graph of all of them kind of looks like this. And if the market, which was here, now has come down, I'm up here now on this long straddle. On this long straddle, I'm up here. On this long straddle, I'm up here. They're all very profitable because if the market crashes, everything comes down with it because we're talking about trading stocks here. Okay. So everything's going to be coming down and all of these long straddles are going to be very profitable. And that is going to be a good thing for me. So I can use it as like a hedge concept against the market crash. And that's what I like about this style of trading. I think of it as a hedge that actually pays me money to put it on. All right. All right. Let me know if that's not clear, but there's just one trade there. Oh, this is the slide I wanted. Okay. So this is what I'm saying. Like these were all live positions, right? So if the market comes down to here, this is, you're going to be very profitable here. Obviously, these are all, traded in small size, but the point is that the more the market comes down, the more money these trades all make because you're riding this line higher as the market comes down. So if the market's down 50%, these trades make even more money, right? The more the market crashes, the more money you'll make from these long straddles.
Question.
And that's ignoring the effect of IV would spike even higher. And therefore, your T0 line gets pushed up even higher too, right? So it's good in those two ways.
I have another question.
Sure.
If the market is doing something crazy, let's say the US bombs Iran or, Freedom Day back in April of last year, would you avoid? So the worst thing that can happen to a straddle is that overall volatility goes down, right?
Yes.
If you're initiating a position when market volatility is when the VIX is at 50 or something, that's probably not a good time to be putting on a trade, right?
Yeah, I'm going to show you a tool that you can use that will give you that data very easily and visually, that you'll see coming up in a sec. But in general, I would say yes, but just know that those types of events, VIX is not at 50 very often. Okay. That's one point. The second point is that even with VIX at 50, the earnings event is still the earnings event, right? And that is what's going to contain a lot of randomness, and randomness is priced into fear, and that's priced into the option pricing as well for that particular stock. So that's the second factor you want to take into account as well. But I'll show you a tool that you can use that will very easily tell you if there's anything, if the price of the straddle is unusually high or unusually low. And that's one of the things that I check in my 10-step kind of criteria. All right. So let's start going through the details of the criteria. All right. So the first thing I've shown you already, this is the filters that I use for Market Chameleon. You can see here that I've sorted by reverse Sharpe ratio or descending. And then I'm simply looking through. So normally what I tend to eyeball is I'll eyeball the median. If I'm looking to try to make money with these things, I'm normally going to prefer a median at 5% or higher. But all of these look, decent. Then I'm also looking at the number of observations. The more, the better. But 5 is what I'll start with as a minimum. But if I've got a whole bunch of choices that are better than 5, then I'm probably not going to be looking at this one. Okay, if I've got a better selection there. So I'll take that into account. I'll also look at the win rate. Obvious type stuff here. If I've got one trade that has a 91% win rate versus another trade that has, a 67% win rate, I will probably be leaning towards the top trade as long as the other criteria matches. Okay. So I'll start with this list. I then have a whole bunch of filter criteria that I go down that trims my list down. And then from there, I just choose the sexiest 2 or 3, and that's it. Okay. But this is where I'll start from. So I do look at median, as I say, number of observations, and the win rate, typically the main things that I'll look at. I will also eyeball the, remember, these are different underlyings here, okay? And notice the worst here is 8%. This is what I was saying before, right? On average, the worst drawdown for a long pre-earning straddle is going to be roughly about 10%. It can be up to about 20. Extremely rare to see it beyond 20. Okay, for these types of trades. I normally don't take into the standard deviation of the return into account. Don't really care. I'm already sorting by reverse Sharpe, so that's fine. obviously the higher this number is, the better. But all this is doing, it's really just comparing your returns through the worst return over here. So, and you can, visually see it for yourself. The other thing that I'll do from this point as well is that this is the date that I'm going to be closing the trade. So I will eyeball my calendar and just make sure that on that day I don't have anything important. So for example, if I'm doing a presentation either for my community or for a partner such as you guys or whatever, I don't want to be having that conflict there, right? Or if it's going to be a trading holiday or anything like that, or if you've got, a recital for your kids, whatever that might be. So just make sure that that's an easy one to dismiss. If you know that on the 11th of February, you've got a doctor's appointment or whatever, you can't trade, then obviously just knock those off the list and move on. All right. So that is step one. Market Chameleon is my starting point. Then from here, I've mentioned the types of things that I'm looking at kind of in more detail now when I start to drill in. So normally I want the underlying stock to be worth more than $10. I don't like trading really cheap stocks. Just as I've mentioned that I look for a market cap of above 1 billion, but I also want the stock price, the underlying that I'm talking about, to be at a price of $10 or higher. Okay. And by the way, if you're wondering how do you determine that from this screen here, you don't see that from here, but then when you click in through to the number of observations, that will then tell you what the actual prices are, which we'll see in I think the next slide. Yeah, you'll see it here. So you can see here, underlying price, and this is the column that I'm eyeballing. If I see something like this, where the stock price of the underlying is under $10, I'll normally dismiss it. Okay, so I want underlying above $10. Check that the option contract prices themselves are above $1. Again, I don't like options themselves now being too cheap. So I want the option contracts to be at least $1 or more. And I want the underlying price to be above $10. Unfortunately, we can't select this in the filter criteria. So this is just something you've got to eyeball when you're looking at the observations. For the bid-ask spreads, so remember, if you've got a bid here of 1 and here an ask of 2, something like this, the easy way, there are different ways to figure out what when is the bid ask too wide or too narrow. The simple thing that I do is I simply divide the ask by the bid, right? Here, obviously, 2 divided by 1 is 2. So if I see that number being higher than 1.3, normally I dismiss it. Unless it looks really sexy, and if it's like 1.35 or something, I might be tempted and go in for it. But if it's 1.5, 1.6 or whatever, and I've got other options to other trades to choose from where it's at 1.2 or 1.1, I will want to have a tighter bid-ask spread. Okay, less slippage means you're not going to be risking that much money just on the slippage aspect of it. And sometimes bid-ask spreads can be wide, so you want to stay away from those. Okay, so bid-ask spread there of 1.3. In other words, the ask divided by the bid, whatever that ratio is, being less than 1.3. And yeah, just a reminder to check your calendar, make sure that you're available to trade on that particular day. All right, so this is when you're clicking in through to the observations, and now you see this. And this is now where I'm scanning for that criteria that I just showed. So I'm scanning through this. I'm basically saying prices of the underlying are under $10, so I would dismiss it. Okay, but since I'm here, we can look at the other stuff as well. I can, from here, also check. So here you can see this is for the long straddle that we're actually placing. This is when we place. So you've got the before and the after. So this is when you enter the trade, and this is when you exit the trade. What is the bid-ask spread? And it's showing you a snapshot of that there. Okay, so I would basically divide 0.3 by 0.2 and make sure that that ratio is under 1.3. But just by eyeballing this is the other filter criteria that I said that if I'm looking at the option prices, I don't like the option prices being under $1. So this is another thing that I would say, no, I'm not trading this particular underlying. Right? I don't like the fact that the underlying is under 10, and I don't like the fact that the option prices themselves are under $1. So, and then I would also be looking at the bid-ask spread based on that ratio in order to figure that out. And that is more or less what I'm looking at when I'm looking at this stuff. And of course, the first thing that I look at is I look at the returns of the strategy historically and see if I'm happy with that. So Again, think of this as walking to a casino table. They tell you these are the odds for playing the game. Do you want to play? Simple as that. Does not mean you're not going to lose, even if they're all green. Okay, the next trade could be a red, but you're just trading based on this data, and then that's it. Brandon's saying here, what are your thoughts on resting exit target profit order based on something, for example, median return? Yeah, I don't put in a so in other words, what he's saying there is once you've entered the trade, can you put in a standing order to get out at a particular profit level? I personally don't do that. There's nothing wrong with doing that if you want to set yourself a particular target, but I just let the numbers play out, and you'll see from my results sometimes you can get lucky, and you'll see an example of that. And yeah, I'll show you specific examples, but I don't put any resting orders in. I simply get in on the day the software tells me, I get out on the day the software tells me, 0 adjustments. It's a slap on, slap off trade. Okay, now I will also eyeball the price chart. And this is what we kind of touched on before in terms of like a market crash or whatever. But here, if I'm seeing a significant move down, this is now where I'm looking at, I'm going, because normally with a move down of a stock, IV goes up. So you don't want to be getting in at the very kind of bottom and then get exactly this kind of thing like this that happens, where you then get a bounce and then you get like an IV crush type of event. And you got in here. This is where you purchased your straddle, and then the very next day you get that big bounce and vol comes down significantly, and now you've lost a whole bunch of value in that straddle. That's not ideal. So normally I don't want to see a really big move down, but even then, if you've got the right tools, which I'll show you next, that can validate whether this has had any actual impact. Remember, because IV is derived. What matters is the price. Okay, so it's nice if we have a tool that can tell us what the relative value of the straddle price is on a day-to-day basis. And now you can just see, has it increased or decreased significantly? If yes, a big jump up, that's bad. And I would absolutely get out. But this is, if you don't have this tool that I'm about to show you, then if you see something that's really big, a really big move to the downside, then that might steer you away from that particular trade and go to something else that looks better, either something that is grinding up or something that's just sideways choppy. Dan says, do you look at the strike price, open interest? Yeah, I'll talk about open interest and stuff like that coming up. All right, so I will eyeball the price chart. I'm just used to doing it, but I will use this tool here to then validate whether it actually has had any impact or not. So what this thing here does is it shows you every expiration, but the only thing I care about is the most current expiration, which will be the top one. So this is a tool here from a site called volatilityhq.com. And so I will double click on this line here, which then turns everything else off. And then I'll also click on the black one down here, which is the average of all of the trades. So I don't want to mess everything up and make things hard to see, but I am interested in seeing the average across all of them and what the current one is. Okay, so notice here that for this one is still, so you can see this is up work. Okay, and notice what's happened here, like over the last 1, 2, 3, 4, 5, 6, 7, 8. So over the past 8 trading days, this thing has come down pretty hard. So you might think, okay, well, IV must be spiking higher as this thing is coming down, and the straddles are getting, the relative value of the straddles must be going higher and higher and higher, right? Well, this thing over here is telling you, well, not exactly. On average, if you look at the black line, it tends to be trending. This is actually a pretty flat line for the rate of decay of that, but it does kind of trend down lower. And then if we look at the blue line, you can see there's nothing extraordinary about the blue line. And notice that over the last 2 days here, we did see a bit of a spike, but nothing that has spiked up to something like this. That looks unusual. That would be absolutely risky. I would never enter a position if it's up here, okay? Especially if the blue line is all the way down here. But then look at what's happened on this day. We did get this bounce, and then that bounce has returned. If you can see it, the blue dot is right here, right there. And it is more or less in line with that kind of trend line, even though it had 2 days of increase, but then it's actually had another day of decrease. This doesn't scare me. So even though I'm looking at a chart like that and going, ooh, I'm not sure I like this chart over here tells me the exact trade that I want to put on, which is just an at the money straddle, is really not mispriced. Not actually, mispricing is the wrong word. It's not overly expensive on a relative basis. On a relative basis, it's fairly, you know, is it a little bit? I mean, if I had to draw a regression line, I'd probably draw something like this. I would prefer that dot to be here. So it's maybe a little bit uh, overvalued, if you want to call it that, but barely. Okay, so that's why I like this tool as well. And the same tool, Volatility HQ, then shows you a chart like this, which is something else that I like to eyeball as well. And let me explain that. So what this is that this is showing you the entry day on the y-axis and the exit day on the x-axis. So remember, t-1 basically means 1 day prior through to the earnings event. t-2 means 2 days prior to the earnings event, and so on. So if we choose a row, let's say something around the middle, let's say t-10, which means 10 days prior through the earnings, this is this row here. So this is saying we enter into a long straddle at the money 10 days prior to earnings. If we then were to exit 9 days prior to earnings, which basically means we've been in the trade for 1 day, on average, that trade is going to have a return of minus 0.6%. Okay. If we enter at 10 days prior and exit 8 days prior, on average, we're going to see a positive return of 3.7%, and so on and so on. Okay. So by looking at the data like this, essentially anything that is warm in color, as in closer to red, means that's where it's profitable, and everything that's gray is a loss. Okay. So for my entry, remember, we're entering 3 days prior, but that's what Market Chameleon says. Its naming is 3 days prior. I will show this in a little bit more detail later on, but basically if Market Chameleon says 3 days prior, this particular tool, Volatility HQ, for its definition of how it tracks things, it would be t-2. So it's one less than what Market Chameleon says. I know it's a bit weird, but just know that. So now I'm looking at this row, and it's basically saying if we enter what Market Chameleon says is 3 days prior and exit just before earnings, on average, it's going to be making 2.1%. And sorry, this is if we hold it for 1 day. And if we hold it for the 2 days, then it's going to make 6.6%. So this over here, this data is validating that I seem to have like a heat cluster around the area that I want to trade. And that improves my odds, if you want to put it that way, or my weighting of this particular strategy in terms of wanting to trade it or not trade it. Okay.
Question?
Sure.
How difficult is it to get the dates into Volatility HQ?
This is all done for you. There's nothing that you've got to do manually. So all you do for this is that you choose the option that gives you this particular matrix, and then all of the data is in there. And if you then hover over any one of these cells, it will tell you the date of entry and the date of exit and every single recorded historical event for that cell. So you'll get to see similar through to what you see in Market Chameleon. So in other words, it would display something very similar to that.
You just have to tell it the ticker?
Yes. Yeah, you tell it the ticker, and then it will give you the full matrix like this. There's nothing else that you need to do. It's very, very simple. Yeah. All right. Okay, so I've mentioned I want the bid-ask ratio to be less than 1.3. So in other words, here for remember this is interactive brokers. I'm looking at the ask and the bid. I don't care about the mid in this particular case, and I do care about which strikes I'm selecting. Notice here that I'm doing the strangle, not the straddle, right? Like notice that this is the 115 for the puts, and then I'm doing the 120 for the calls. because I want my position deltas to be flat. So in this particular case, I couldn't find a long straddle either at 115 or 120 that kept my position deltas flat. So I had to split my two strikes in order to give me flat position deltas. Okay. So now that I know that these are the two things that I need to buy, now I'm going to be looking at these two and I'm going to be looking at these two here. So then I'll do 470 divided by 430 and see what that ratio comes to. And 550 divided by 510, look at that, what ratio it comes to. I want those ratios to be under 1.3. Okay. Which they would be in this particular case. Otherwise, I'll dismiss the trade. This is just something that I'm used to. It's software I use all the time called Option Net Explorer. You don't need it at all, but I just like to visually see the trade. I also use it to just track my live positions and so on. So it's not necessary, but I do like to visually construct the trade in Option Net Explorer as well. If you're using interactive brokers in particular, their modeling to look at a risk graph is absolutely horrible. Whereas if you're with Schwab, Thinkorswim have a good options modeling technology built into the platform, but with interactive brokers, it's just horrible. So you really, if you do want to look at a decent risk graph, you ideally would be using Option Net Explorer, but it's not necessary. Okay. But I'm just kind of like a visual guy, and I like to see the risk graph. So I will construct it there. And then from there, I basically I have a notepad right here next to me, and I'll keep a short list of the stuff that has passed all of my criteria. And then the stuff that's passed all my criteria, I'll write down the stock name, the median return, what the position is. So here in this example, I've said it's the 190, 195 strangle times 3, which basically means I'm doing 3 contracts because I've simulated it here, right? So for example, I'll start off and I'll do just +1 here. And then in this particular example, I'm then looking at what the deepest point is on the risk graph. And, here it's, 1.3K. And if I've done my sizing, for example, such that the deepest point needs to be at around $2,000, I will then say, well, that's not deep enough. So I will then add another contract to get it down through to about $2,000. Because remember, you want your sizing to be consistent from trade to trade, right? So so I'll write down what if it's a straddle or a strangle. If it's a strangle, I'll list out the strikes. If it's a straddle, it might be like 45 strike straddle, times 2 kind of thing. It could be something like that. And then I'll also write down the position mid price, because even though I will start off my first limit order at the bid, I will then start walking that up, but I want to have an idea of roughly where ideally I hope to get filled at, which is somewhere close to the mid, right? But I don't, if I'm not getting filled at the mid and not getting filled 10 cents above, not getting filled 20 cents above, that's where I start to get nervous. I might say, you know what, I might pull out of this particular trade and not really just chase it for the sake of chasing it. And that's it. And then I submit my orders and I walk it like I've mentioned to you. Normally I'm in for like 5 minutes max. And I tend to enter 2 or 3 positions per day. That's it. And you can see here all of the examples of all the straddles I've been entering over the past month. Okay, this here, I've kind of explained this already, but I've explained the difference between before market open and after market close. And the key thing is just a reminder that if you are using both of these tools of Volatility HQ and Market Chameleon, that Volatility HQ is we need to reduce the numbers that they show on their matrix by 1 in order to make it match Market Chameleon. All right, but I've pretty much already explained that. Here's, by the way, what I mentioned before. When you hover over a cell, you could see here it tells you the entry day, the exit day, and then the median return, and then all of the prior historical returns for that particular straddle of entering at that day and then exiting at whatever other day. All right, so as I say down here, if Market Chameleon says 3 days before is your entry, then when you're looking at your matrix here in Volatility HQ, you're going to be looking at T-2, not T-3. All right, you got to reduce it by 1. All right, so those are the two tools that I use. I've shown you exactly how I use it. I also have shown Option Net Explorer. That's not necessary at all, but I find these two tools here in combination to be quite useful. If you ask me, if I could only select one, which one would you recommend? I would recommend this one here, right? Just seeing that list of matrix, that's really all you need. You don't even need to look at a risk graph, as long as you're being careful to, of not making fat finger errors and doing the right strikes. And that's part of the reason why I do like to visually see something like this, So it's just a way of me visually confirming that I'm putting on the trade that I think that I'm putting on. And the other thing, by putting it into Option Net Explorer, I'm looking at the position deltas here. And here you could see it's at 2.91. I can see it's pretty relatively flat. I'm okay. But if I'm putting on a position like this as an example, let's pretend this number over here was at, I don't know, minus 20 or something like that. I would prefer to not be at minus 20. That's now getting into a directional bet. I want it to be bearish. I don't care which direction it goes, right? I'm trying to play these other odds here. So in that particular case, I might then split out my put and move this down one strike. So I've got my put here and my call here. And then that ends up creating a straddle that looks like, sorry, a strangle that looks like this. And then my position deltas are now going to be more flat like that. Okay, so I'll try to get a straddle at some strike, but I want my position deltas to be flat. If I can't find a straddle, I will then split by one strike in order to convert that into a strangle, and that's what I'll get in. And that is it, right? That's in the entire process. And so now here's an example, because I did like a preliminary type of demo here of this type of strategy, and then one of the people in my community ended up putting on a trade and said, "Oh, hey, I got a horrible fill." He was instantly down money, and then I took a look at it. I'm like, "Holy moly, this looks horrible." But that is because I hadn't fully expanded on all of the criteria that I look at from a filtered thing. I was just doing on autopilot. But let's look at that. Okay, so we're going to look at this trade, which is something I would not recommend, but you'll see why. So first thing is that when you're just looking at the returns look quite good, right? As a matter of fact, they look very attractive. Notice a return of 83%, 50%, 33%, 28%, 41, 16. And then in terms of the losers, only 6.7, 3.7. That looks really, really, really good. These are good odds to play. So that part there is fine. But now when we're looking at this particular trade, notice that this is 1 week before is our entry. So this would be like 5 trading days, right, prior through to the thing. So if we're looking at the matrix here, this would be the T minus 4, our entry. And now this is what we would be trading. And then from here, notice that not only are we expected, based on this data over here, to actually be negative by the end of it, but on top of that, we're going to be carrying losses from day to day. So, and notice that there's no like a heat, like reddish thing shown in this kind of section down here either, which is not a good confirmation, right? But that's one thing. The second thing, like I said before, I don't like trading stocks under $10, and this one over here is, so therefore that would have been something I would have dismissed. Then I've mentioned that I don't like the option contracts being priced at under $1, and therefore that is something I would have normally have dismissed over here. You're also going to be looking at your bid-asks spread there. Yeah, but yeah, I mean, look at how cheap some of these things are. Like, a 5 cent thing. Remember what I explained before about the fact that even really far out of the money stuff that is almost expired is not going to be selling for less than 5 or whatever. And when you then see option prices pre-earnings priced so cheap, it's like, no, that's just not something I want. Then in terms of open interest, you can see here there's like zilch everywhere. Pretty much there's nothing except a bit, a decent amount of volume at this particular strike, but then just nothing anywhere. That is another warning sign there. Then here, notice that, so if you were to do the at the money straddle at this particular strike, here you do have a bid and an ask even though the bid is only 5 cents. But then notice here, because this is the strike that you'd be doing, there is no bid there at all. Nothing. Okay. So not just is there no open interest, but there's not even a bid price there. There are no buyers there. So instantly I would, dismiss that. That's what I was explaining. It doesn't matter if you're doing this strike over here, this bid is missing. And then if you do this straddle over here, this bid is missing here. So yeah, that's not a good option at all, right? But now that I've fully documented all of the criteria that I normally check, hopefully that helps you out. Question here. How does Market Chameleon show consistent winning odds and volatility shows consistent losses? Yeah, I think you're referring through to the prior screenshots that I had here. So let me just eyeball that. It's possible that it could be like being on the wrong row sometimes. So ideally, you'd want to just go through. Where's my cursor? Ideally, you'd want to go through and hover on the particular date and just ensure that it matches what you're seeing on the other one. It could be just, I'm guessing here, that it could have been this one here. The one row kind of below the one that I thought it was is showing sort of positive results. But normally, the data that you see from here between this and between the two tools, basically, is going to be fairly closely related. There will be some discrepancies there, but normally it's not going to be one where it's showing you that the average or median return from one is quite positive and the other one is quite negative. So yeah, good pick up on that one. All right, so here I'm just going through a couple of examples of other positions now that you guys know all the criteria. So this is entering 3 days before, exiting just prior. This is a position called FFIV. Notice the returns is the first thing that I'm looking at over here. It looks excellent. Not even a single loss. And all the numbers here look really, really good. If I'm looking at the underlying price, well above $10. If I'm looking at the option prices, well above $1, that all looks good. If I look at the historical bid-ask spreads, they all look decent as well. That'd be under 1.3. So everything there looks very nice. This was the position at entry, and you might be wondering, why is this already showing some form of loss? It's showing a 2.9% loss. This is basically just slippage. Okay, this is the real price. Like the simulated price before me entering the position would have had my position perfectly at 0, like that. But after I got filled and then I updated the prices in the software, then you're instantly kind of like underwater a little bit just based on slippage. So that's why it's slightly underwater. But that's what it looked like at trade initiation on Jan 23rd. This is pretty much what happened 2 trading days later, right? Price, the underlying went up, and here's my trade. And again, if I go back, the software was telling us we should be down here on the gray line 2 days later. And yet, 2 days later, the entire line is above 0. Okay, and we're up at 15% return there on the trade. All right, so that's just showing you the P&L there, the actual fill prices on the contracts here, and this is after slippage and everything else, up 16.8% return in 3 days. Okay, RMBS. Entry 1 week before, exit day before earnings. So first thing I'm looking at here is, do I want to play at the gambling table, right? These are the odds and the returns. Do I want to play? All look good, excellent returns there. Losers, remember, when they lose, you should expect that on average they can lose up to about 10%, but it can be up to 20, right? So that all is in line with things being normal. Prices above 10, option contracts above 1, bid-ask spreads over here at a ratio better than 1.3. All looks good. So again, this is 1 week before. So this would be the T minus 4, which is this line here. And this is what would be trading. You can see that all looks really good. So this is confirming. And not just that, but we also see some like reddish or orangish stuff with positive returns within this kind of cluster area as well, which is something I like to ideally have, right? So this is what it looked like at trade entry. Again, slightly underwater there because of slippage, minus 1.2%. And here it is after. Okay, again, the entire line above zero there. Profit of $170. Max risk of this point here was to 2059, which you can actually get the value from there. 8.3% profit in 3 trading days. All right, this is just what the IV chart looked like if you're going to eyeball that. But this is not giving us, sorry, not the IV chart. This is the relative value. So the change in the straddle prices, right? This is the same thing, showing you where we actually entered.
Wow, that's fantastic, Ron.
Yep. So are you saying, are we out of time? Is that what?
Well, we should be at least pretty close. I mean, are we near a break point?
Yeah. These next slides here are all quick because you all now know what my criteria is. And so I'll just finish showing these examples. And then the last thing was just to show you maybe this thing live. So I can actually go in and show you, like for today, if I had to choose some trades, what those trades would be. So yeah,
To
shouldn't
get
be
out
too
of the
much longer.
building sooner. But you can go, we can push our luck or, I don't know. It's up to you.
Yeah. Well, you tell me. I'm happy to keep going as long as you guys are okay.
I think we better not push it too far.
Sure.
Could you like go just like on for another 3 minutes or something like that?
Yeah. Look, what I'll do is let me show you the summary. So this is all of the straddles without skipping anything, right? Over the past month. The one that I exited today was a loss, right? But again, it's within, normally it's around the 10% kind of thing. Oh yeah, actually I did want to show you this one. Let me show you. This is a really interesting thing. It's NVO. This happens sometimes, and you can't bank on it, but it's nice when it happens. So, all right. So normal criteria here. So again, if I look at these are the odds of playing the game. Do I want to play? Yep, everything looks great. Price underlying above 10, option prices above 1, good bid-ask ratio, everything looks cool. This is a single day trade, right? And get in 1 day prior, exit the next day is confirmed in the return matrix. Here's my entry. But on the morning, so normally I get on the day prior to the close, and I was meant to get out prior to the close on the next day. But then on the morning of that particular day, news got leaked of what they were going to be reporting on. And this happens every now and again. And it was bad news. So bad news leaked out that they were not hitting their sales targets over here. And you can see what happened with the stock price. Okay. And so now this is at 1:20 p.m. Eastern, because remember the markets close at 4 p.m. So this is still hours to go. Look where the position is here. And this is the kind of thing of, what happens during a market crash. This is like a little example of that kind of thing. So this position was up. And as soon as I saw this, I'm like, I'm out. I'm happy, right? I'm not going to risk the market then coming back up and then losing that money. So I immediately, when I saw that, I said, okay, I'm happy. I'm out. I was out for a 70% profit there in that particular example. Okay. So And these are examples of, in this particular case, it is relatively rare that news will get leaked, but it does happen, right? It's happened to me a number of times. And it's almost always a profitable thing because no matter which way, like if really positive news gets leaked, then you're somewhere up here. Really negative news gets leaked, you're down here. Okay, so that's the really nice thing about a straddle, right? If it moves big, the bigger the move, the better it is for you. So, but the summary here was of all of the straddle trades all the straddles that I've done over the past month, and you could see it made 143% in 1 month. This is just summing everything up. 9 winners, 3 losers, 75% win rate, which is in line with the global statistics of what I normally trade. Average return of 11.98, but we had an oversized return. Okay, so you want to look at the median, and still a median return there of 7.05% per trade, including all the losers. Okay, so again, this is an example not just of a good trade to do with good stats, with real stats of historical trades that you can basically bank on. And by the way, when I have a loser, so I think I actually checked this out for the DLR. Let me quickly check on that. And because one of the things that you want to do when you're looking at a tool is you want to make sure that when your trade has lost, so this is the DLR, this is one that had a loser trade. Actually, I'll show you here. So you could see it's a 11.5% loss that I got on my trade. When you're using tools, you then want to make sure that the tool is reporting the same thing that you got or very, very close to it. And you can see here the tool is reporting an 11.2% loss. I got an 11.5% loss. That's what you want to see. You don't want your tool to basically say this was profitable at 7% because now you're saying, well, that's not tracking reality, right? So I don't know what the hell the data is that they're using. It's not real. And therefore you want to dismiss that particular tool. But here you can see Market Chameleon is quite accurate. It may not be an exact perfect match, like mine was 11.5, but you've also got slippage and that kind of stuff, but you want it to be relatively close, and it is. So it is a reliable tool to use, right? The data that they show is, at least in my opinion, quite accurate. All right, so that is that. If you want, I can show you this live, but if we're out of time, I guess we're out of time. So
well, we're pretty well out of time, but
sure.
Do you want to show any links?
Oh, yeah. If you're interested in these tools, I mean, I pay for them myself, but so for Market Chameleon, if you use my affiliate link here, you'll basically get a 2-week free trial instead of a 1-week free trial. And 2 weeks should be plenty of time for you to make some money from these earnings strategies that I'm showing just by following exactly what I've just shown there. So that's the link there. And then if you want Volatility HQ, their normal price is $99 a month, but they have a 50% discount coupon that you can get from this URL here. I'm not showing the discount coupon because it's not mine. It's from this other community called Steady Options, but you don't even have to sign up for an account with them or anything like that. This is just a publicly viewable forum thread. And if you click on this link, you'll get the discount code there, which you can then enter in, and you'll basically be paying $50 a month for Volatility HQ.
And how about your community?
Yeah, my community, the type of presentation that I'm doing here, this is just me showing that I've done close to 250 sessions like this for my community so far. So there's just a mountain of really useful information in there. But you'd have to buy into the PMTT course that I sell there, which teaches you advanced option trading. And then I make the mastermind community available as a payable. It's like a $30 a month, which is stupidly cheap. But anyway, it's a membership that you can get only for that community of people, though, because we expect a certain level of knowledge so that we don't have to talk about extremely basic stuff, because that's what it's a minimum level of education that we expect from people that interact in the mastermind community is what I'm trying to say. So the expectation is that you complete all of the PMTT course first, and only after you've completed that, you then decide if you want to join the mastermind. But you can see there's just a mountain of really useful information within all of our historical archives. You can see here from the duration, I normally go between 2 to 3 hours every single session. Okay.
Well,
and all fully searchable
great.
and so on.
Super. I mean, that's a tremendous course, that you've given here. I'm sure it's equivalent to an effort to more than just about anybody else has put into this subject. Thank you. Will we be able to have the transcript or the slides?
Sure. Yeah, I'll
Or
see if I can
some of
get
them,
some.
as many as you're comfortable with giving, let's put it that way.
Sure. Yeah, I'll see if I can pass
Super,
some
that's
of that.
great. And you and I can discuss separately whether, I don't know, if we left out anything, maybe we can figure a way to get it in. Thank you so much.
Yep, no worries. All right, guys.
Thank
Thanks.
you. We better, the security's here, so we better kill the recording and get out. Thank you so much.
All right. See ya.
Thanks, bye. Yeah, please.